there is a substantial amount of froth in these markets. So we have an equity bubble. These bubbles is that they do come to an end. And when they come to an end, it can be really quite sudden and quite violent. And I think for an investment manager, that's the first thing he's really got to understand. When it pops, then there is going to be a huge second problem, because when it pops, you're going to get a market that goes down considerably. I'm talking about equities here. You will see an increased amount of risk in bond markets, which basically means their yields will rise at the same time. You've got to invest in mining stocks. And I'm not just talking about gold and silver, but base metals in particular. Agricultural products, perhaps, because I think these prices are going to rise. They're going to rise very substantially. That's going to be the new place to go.
In today's news recap, China scraps gold tax break, sending shockwaves through global bullion market. China has abolished a long-standing tax incentive on gold sales in a move that could raise costs for consumers in one of the world's largest bullion markets. Effective today, the Ministry of Finance announced that retailers will no longer be allowed to offset a value-added tax, VAT, when selling gold purchased from the Shanghai Gold Exchange. Bloomberg reported. The new rule applies whether the gold is sold directly or processed into other forms, covering investment products like high-purity bars and coins, as well as jewelry and industrial materials. While the change is expected to boost government revenue at a time when weak economic growth has strained public finances, analysts warn it will likely increase the cost of buying gold for Chinese consumers. The policy shift comes amid a period of high global demand for the precious metal. Despite the correction, gold remains near the $4,000 an ounce level, and some industry players still expect prices to reach around $5,000 within a year. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
I mean, we are in a credit bubble. I mean, there is no doubt that bank credit has been expanded in favor of financial assets. And more than anything else, this is really what drives equity markets in particular. And we've seen this. We've seen this really over the last 2 years with the S&P rising from 4,000 or less or whatever. Currently, we're looking at 6,900, thereabouts. I never follow it that closely, but I mean, we're talking about a substantial rise. And the background to this has been a gentle drift in bond yields. I mean, they peaked, if you look at the 10-year, it peaked at around just a bit under 5%, I think, a couple of years ago. It's gone back and up and down. And currently, it's around about 4%. So that has been a fairly benign background against which there has been a substantial increase in the amount of credit aimed at assets. And if you look at the level of margin finance, which is a statistic that FINRA runs, margin finance is running at an all-time high. I mean, we're looking at $1.12 trillion. Bearing in mind that 10 years ago, we were looking at about $250, $300 billion. We're now, now well over $1 trillion. Now, the point is that finances positions probably about 3 times that. So there is a substantial amount of froth in these markets. So we have an equity bubble. So far, this is rather like the roaring 20s, 1926 to 29, when everything was tickety-boo. Everybody in Wall Street was extremely happy. People in Main Street weren't doing terribly well. They were holding body and soul together, but not an awful lot more. But, the real happiness was really in major city conurbations, where all the wealth was being created in markets, and it was sort of spreading out into the restaurants, into second homes, into fancy holidays and all the rest of it. And that's where we are today. The problem with these bubbles is that they do come to an end. And when they come to an end, it can be really quite sudden and quite violent. And I think for an investment manager, that's the first thing he's really got to understand. He may be a very clever fund manager and made an awful lot of money for his clients by, sort of playing the momentum stocks and Bitcoin or whatever. But just bear in mind, the whole thing is driven by credit expansion aimed at puffing up assets. And that basically is what's been happening. That comes to an end. And if you're left holding the baby when it ends, you are going to lose an awful lot of money. So I think that's the first thing that you've got to plan for. When it pops, then there is going to be a huge second problem, because when it pops, you're going to get a market that goes down considerably. I'm talking about equities here. You will see an increased amount of risk in bond markets, which basically means their yields will rise at the same time. Now, this is an awful combination, but this is what happens. This is what happens when a bubble pops.
In today's news recap, UBS silver price forecast, buy the dip opportunity, $55 target retained. The silver price in US dollars ended the week at $48.66 per ounce, down 0.92% on Friday, but still modestly higher over the week after a volatile run that saw daily swings of more than 2%. Silver has pulled back from its record highs near $54.50 per ounce, yet UBS continues to view the correction as temporary and maintains its bullish target of $55 per ounce by mid-2026. UBS said the recent drop was driven by profit-taking from momentum-driven investors, not a change in the metal's outlook. The bank added that lower nominal and real interest rates, global debt concerns, USD debasement, and expectations for a global growth recovery in 2026 should drive silver prices higher. The bank expects the gold-silver ratio to narrow to around 76 times, with potential to reach 70 times, a move that would further support silver's relative strength. This backdrop should continue to support strong investment demand, UBS said, forecasting ETF holdings to surpass their all-time high of 1,021 million ounces, up from about 820 million ounces currently. Based on our gold price forecast of $4,200 per ounce and our view of the gold-silver ratio, we project a silver price of $55 per ounce by end June 2026, UBS said, calling the latest dip an opportunity to position for further upside. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatic's handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
You get a situation where people who have portfolios which they're using to secure other finance, they get sold out because it no longer covers the bank's liabilities. You've got other problems that come from the increased risk being reflected in higher bond yields. You've got all the zombie companies in the economy who took out all that debt, particularly when interest rates were at the zero bound, and in other countries at negative interest rates. They're in the business now of having to refinance that. I mean, we're looking 5 years on. So this is not good. And as far as government is concerned, they've got huge debts, which are going to prove to be even more difficult to finance in the event of rising bond yields. So how do they handle all this? They're going to have suddenly all these obligations coming through, because apart from anything else, their welfare obligations are going to go up. And at the same time, their tax income is going to go down. So they're going to have larger budget deficits. So, this is going to be very, very difficult. So that's the second, if you like, element, which I think you've really got to start thinking through. In terms of investment strategy, I would look to sort of start easing my way out of the momentum stocks. They may go further. You're never going to hit the exact top. But I would look to lessen my exposure to those. And the other thing I would then do, and maybe not immediately, because I think as the bubble pops, you're going to get a substantial amount of selling across the board. And anything where people have got profits, they're going to be just realizing them and running the losses. I mean, that's the way it works. So there is going to come a time, I think, when you're going to sort of start thinking, right, we've got to invest in mining stocks. And I'm not just talking about gold and silver, but base metals in particular, agricultural products perhaps, because I think these prices are going to rise. They're going to rise very, very substantially. That's going to be the new place to go. And good technical analysts are already seeing this beginning to develop in the wider commodity sphere. So I think that's your game plan. The timing obviously is up to the individual investment manager, and I wish him jolly good luck. So to summarize, I think the first thing is you've got ahead of us, we've got a credit bubble popping. But realize that when it happens, this sort of neo-Keynesian idea that the Fed can control interest rates and bring down interest rates and bring down bond yields. No, that's rubbish. That's not going to happen, because what will happen is that bond yields will start reflecting the risk in credit. Not risk, but I just add the three elements of this risk. If you go and buy a bond, you're losing possession of the money, if you like. It's going into the bond, so you can't use it for something else. So there's an element of interest payment to cover that. You've also got individual borrower risk. So that is another thing that you take into account. And increasingly now, there is another factor. And that is, when I get my money back, let's say dollars, let's say in a year's time, what's it going to buy? What's it going to be worth? What's the purchasing power of that money which I've committed to a bond or whatever? What's that going to be worth? So you can see that these three elements are likely to rise quite considerably as credit risk begins to dominate our thinking. And under those circumstances, I think the forward thinking that an investment manager does has got to sort of, if you like, just encompass those very, very facts. So I think that's what I would say.
What do you think of today's show? Do you believe that the current gold and silver sell-off is some sort of coordinated attack against the metals, as Alasdair says, or on the contrary, is just big players taking profits after an abnormal rally? Post in the comments section your plan for gold and silver, and share with the stackers if you are taking any profits after the mega rally we experienced this year so far. Now, peep this video right here because it's a perfect fit for you, and I'll see you on the other side.